With that, it's time for a special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from one sector every day. And the sector in the spotlight today is the metal space. Nigel is going to join us and tell us just how Q1 might be for a lot of the metal majors. Nigel.
Well, let's begin with the ferrous space first up, where steel companies are expected to deliver a strong performance in the first quarter. The steel EBITDA is projected to rise between 4 to around 15% on a quarter-to-quarter basis. That's thanks to two factors. One is a rise in domestic steel prices by roughly around 2,000 to 2,500 rupees per ton, and a decline in coking coal costs by around $10 to around $12 per ton. However, this margin improvement is expected to be partially offset by higher iron ore costs as well as lower sales volumes. The volumes could decline by around 3 to around 17% quarter-on-quarter, mainly due to the planned maintenance shutdowns and muted export demand. And also the early arrival of monsoons, well, that's going to be a bit of a dampener on the volumes front. On a company-specific basis, all companies will report an improvement on the EBITDA per ton. Tata Steel India, well, the EBITDA per ton is expected at around 14,500 rupees per ton, while Europe is expected to trim its losses to around a negative $28 per ton. That's down from close to around $40 per ton in the previous quarter. JSPL as well will report a solid gain. The EBITDA per ton is expected to jump up to around the 13,850 rupees odd, while JSW Steel will clock an EBITDA per ton of around 10,820 rupees per ton. SAIL, well, that'll see a modest improvement. The EBITDA per ton will move closer to around that 8,000 rupees odd mark. Jindal Stainless from the stainless pack, well, that'll report a good bounce back. Remember, quarter 4 was quite soft. This time around, there'll be a 10% quarter-on-quarter growth in the consolidated EBITDA per ton and could come in the vicinity of around 18,200. Two factors support them. One is realizations, which are higher, and the cost of production, which will be relatively lower. Moving to the non-ferrous side of things then, quarter 1 is expected to be soft. That's because of the decline that we've seen in commodity prices. The average LME prices for aluminium as well as zinc, they are down by close to around 7% on a sequential basis. That's what could weigh on the profitability as well as on the top line. However, silver has bucked the trend. It's up close to around 5 to 6% odd. It's hit its highest levels we've seen in more than 10 years. Coal India, though, they're expected to report a 20% drop in the EBITDA. That's because of lower volumes and pricing. You have also seen the e-auction prices that are lower. The cost of production for them has moved up as well, so that's what will hurt Coal India. NMDC could see a 5% growth in the EBITDA. That's because of the higher volumes, which will jump up by mid-teens, though the benefits will be limited due to higher cost of production and lower realization per ton. Hindalco's India business, well, that'll get hit because of aluminium prices, which are down. And also we have seen that, the cost of production as well could get a hit a little bit. While Novelis, its overseas subsidiary, that'll see a 9% quarter-on-quarter drop on the EBITDA per ton, should come in at roughly around $450 on a per ton basis because their operations have been impacted by tariffs on Canadian imports into the United States, rising input costs as well. Vedanta, well, on a consolidated EBITDA basis, there'll be a decline out there because of aluminium and zinc prices. Both of them are down by close to around 7%. However, gains from lower alumina cost and increased captive sourcing, that's what will help partially offset some part of that impact. To sum it up, metals sector in quarter 1 FY26 is expected to be a tale of two halves. Steel companies are poised to report strong earnings momentum supported by rising prices, falling coal cost, while non-ferrous players, they'll face profitability pressure owing to the drop in commodity prices. Let's wind this down with the valuation snapshot that we have up for you on the screen. Well, let's welcome Ravi Sood, the research analyst at Elara, who joins in on the show. Hi, Ravi. Thanks a lot for joining in. It's been a while since we had you on the show. Give us, the outliers for the sector. In the ferrous pack, which company are you expecting to report very, very strong numbers? And what is your top pick? So let's get the ferrous section first out of the way.
Yeah, good morning. So basically, on the steel front, barring JSW and SAIL, rest of the companies should report a negative volume growth. For JSW, the recovery in EBITDA should be sharper because of combination of higher volume on account of the new blast furnace as well as steel pricing. Apart from this, in steel Europe, we should see a sequential basis, driven by lower losses in UK and improved.
Right. Ravi, got a little bit of a connection issue, I think so. I just want to get a couple of numbers out of the way. For Tata Steel Europe, the EBITDA per ton loss is expected to come down, and Nuvama estimate said that it will come down by close to around $10 per ton. What are you factoring in terms of an improvement, and when do they break even?
So break-even is expected in the second half. In terms of EBITDA per ton, overall, Europe, so roughly about negative $32. We are expecting it to be closer to $35, $36 this quarter.
Okay, got it. All right. And from the non-ferrous pack, do you think the street will look through the weakness that we've seen in prices? What is your view on a stock like Hindalco? Because Novelis yet again will get impacted, but the street is bracing for this impact, right, because of the tariffs. So $450 per ton is what some analysts are working with. What about you?
So yeah, basically there should be a hint of the tariffs, which should result into a fall in EBITDA per ton for Novelis from about 495 to closer to about 445 to $450. But what is important to look at is the fact that Q2 we should see a recovery in profits driven by improvement in energy prices that we have seen, and taking into account the demand supply situation, the sustainability of aluminum prices or the relatively higher is more likely.
Okay. All right. Ravi, appreciate you joining in. Thanks a lot for giving us all of those details. We'll touch base as the course of the metal numbers do start coming in. Short point is steel will shine brighter, while the non-ferrous pack could see some pressure because of the pressure that we've seen on LME prices. Though silver will twinkle a little bit more than the other commodities that we've seen.